Okay, guys, so today's class, we're going to talk a little bit about commercial loans, the different types of lenders, different types of loans, and how it varies and differs from what most people expect when they are buying a property on a residential loan. So, number one, first and foremost, understand that commercial loans are completely different than residential loans. There are less protections in commercial loans than there are in residential loans. They do not fall under RESPA, the Real Estate Securities, the Act, and so it's almost like a buyer beware. Now, when it comes to lenders, a lot of commercial lenders are very much a lot like the commercial real estate agents in the sense that they specialize in one type of loan. So you have lenders that do just construction loans. You have lenders that do only SBA loans. You have lenders that do your typical acquisition loans, but some only specialize in multifamily. To that extent, they could specialize just in doing multifamily. And then there's also hard money loans as well, hard money lenders. So it all varies between, what they have. Now, there are some lenders out there that are large enough and they have different departments that they do all types of loans. For instance, Icon Capital Advisors, they are able to do every type of loan from bridge loans to construction loans to acquisition, refinance, cash out refinance, and SBA financing. So, it depends on the lender, and what we try and do is match up the best lender for the client that's going to get them the best deal and, more importantly, be able to close the transaction. So, when we talk about the types of lenders, not only are there banks, not only are there brokerage companies, but there are also insurance companies, which you normally don't see in the residential side. So you have insurance companies that do a lot of financing for the commercial real estate industry, usually much larger deals, but also some of the smaller type transactions as well. So essentially, the types of lenders, you have banks, credit unions, insurance companies, and also private lenders. Okay. Now, the types of loans. We kind of touched on that a little bit just a little while ago, where you have your typical, most people, when you hear about a lender, they have what they call a acquisition or, purchase financing. That's what most people expect when they talk about a lender. But also there's different types of financing that in commercial real estate that we can do, such as AC rehab or acquisition rehab. So, which may be also considered a bridge loan. So, what they do is they will fund the acquisition of the property. They'll hold back the loan will be actually for a little bit more than what the amount typically would be for the acquisition. And that would go toward a refinance. When a buyer is doing that, let's say they're purchasing a property that needs a full rehab, it has to be gutted out. And so you have a lot of expenses there. So a lender can come in and actually finance the acquisition, and then they hold back some of the funds based upon a list of work that the buyer is planning on doing to the property. And then from there, they will slowly fund that the rehab of that, in stages, depending on where they are within the rehab side. And then it converts into a permanent financing. So that would be called bridge loan, bridge to permanent financing type loan. Okay. In addition to that, you also have lenders that will do SBA financing, which is Small Business Administration. The benefits of SBA financing is that a purchaser can come in for a much lower down payment. The way SBA works is the bank loans what would typically be their typical loan amount, and usually about a 65% loan to value, or what they call LTV. And from there, the government guarantees and finances the difference up to 90% of the purchase price. So it allows small businesses to come in and purchase a property for their own use. Now, there are at a much lower down payment. Now, there are caveats to that, meaning SBA financing, typically you're looking at $4 million or less on the loan amount. And in addition to that, the purchaser has to occupy at least 51% of the property. Okay? Yes?
Is there a time frame that they have to also conduct a business?
Is there a time frame? That's a good question.
But no.
The assumption is that they're going to be occupying the business there for its permanent business. And part of the qualification for an SBA financing is that the lender is, the purchaser should already be in business. It's really not set up for small startups. It is a small business administration loan. So startups are not necessarily going to qualify for that. Negatives about some of the SBA financing can be that they might cross-collateralize on personal assets, such as a home, because you're doing a much heavier or lower down payment. So that could be a potential negative as well, including personal guarantees. So the other difference in commercial loans versus residential loans is amortization schedules. Most residential loans are under a 30-year amortization schedule. Okay. Some I've seen upwards of 40 years. There are 40-year amortization loans out there, not that many, but there are some out there for the residential side. In commercial financing, and you can get a 30-year amortization loan on multifamily, but almost all of the commercial loans other than multifamily are going to be a 25-year amortization schedule. So understanding that, since it's a smaller amortization schedule, it could impact cash flows more so than a 30-year am.
No more than 25 years.
Very rarely more than 25 years. Typically, it's, and when I say very rarely, you're not going to see one typically at all. There are some lenders that may push it out a little bit more so, but you're going to pay a much higher interest rate for that. So it almost offsets the longer amortization schedule. There are shorter amortization schedules, like a 15-year. Okay. Now, and the reason why I bring that up is one of the key differences as well in commercial real estate versus residential real estate is that the loan itself, very rarely do you have a fully amortizing 25-year loan. Meaning the term of the loan does not go out for 25 years. It's amortized over 25 years, but typically the term is a 10-year term. So what that means is that at the end of 10 years, there's a balloon payment. Okay, and the person has to refinance. This is a way that commercial lenders can protect their downside in markets where interest rates may be going up. Okay, so where to get a fully amortizing loan? 15 years. Okay, so on a 15-year loan, you can get a fully amortizing 15-year loan that goes the entire 15 years, so you don't have to worry about refinancing. The issues that you run into is it's going to be a much higher payment. Okay, because you're paying down the loan and paying it off in 15 years versus 25-year amortization schedule. And so because of that, it's going to impact your cash flow heavily. So it may also require more down payment so that the property will be able to cash flow positive, or so that the lender, no lender is going to give a loan where the loan payments are more than the income that the property is producing. In fact, they have what they call a debt service coverage ratio, also known as Dscr. So you may hear the term Dscr. What's the Dscr? And typically speaking, right now, we're looking at about a 1.2 Dscr, or debt service coverage ratio. Sometimes as high as 1.25. There are some types of tenants that have long-term leases, like let's say it's a S&P A-minus, A-rated, or A-minus rated tenant that has a 20-year lease term on it. In that situation, you may be able to get a loan that's going to be fully amortizing, or a lower debt service coverage ratio, as well as 1.15. Like a 7-Eleven or Walgreens or CVS that has a long-term lease on it. So now, what does DSCR mean? Does anyone know that here? Or debt service coverage ratio? Okay.
No.
All right. So a debt service coverage ratio is it's a factor of the net operating income versus the loan payment. So a 1.2 debt service coverage ratio means that the net operating income has to be 1.2 times the total loan payments. So if the loan payments are $100,000 a year, $8,333 a month, then your income, your net operating income, has to be $120,000 a year. Okay, so it's 1.2 times. This is a safety net that the lenders build in, just in case there are some vacancies or something may happen, things like that. So it's a 1.2 times the net operating income.
Well, they want the income to be more than the loan.
Absolutely. So they want the income to be more than what the loan payment is. So bear that in mind. So even though a lender says that we can do a 65% LTV, if the income's not high enough to meet that 1.2 debt service coverage ratio, then they're not going to loan 65%. They may loan 60% until the ratio gets to that 1.2. Okay. Same goes for multifamily. Multifamily loans are a little bit different because it's kind of a hybrid between some residential and commercial properties. And you can potentially put down as low as 25%, not 35%. So most commercial loan lenders are going to require at least 35% down, except for multifamily loans, which may require 25% down. Now, the difference and the issue that you run into is that you have the debt service coverage ratio that you have to take into consideration as well. So even if the lender says, we'll give a loan for 75% of the purchase price, they may not if the property's cash flow and net operating income is not high enough to support that debt service coverage ratio. So that's something that you really need to take a look at when it comes to the lending side of life. The other issue that you run into are prepayment penalties, or not issue, I should say. The other difference is prepayment penalties. Typically speaking, there are prepayment penalties in residential loans, but they are typically structured a little bit differently. And, I've seen everything on the commercial side of life, from a prepayment penalty all the way through the loan life or all the way through the 10-year term. And what that does is, with the prepayment penalties, typically you're looking at a buy down on the prepayment penalty, or no, I shouldn't say buy down, burn down. So it may be 5% the first year. That when someone talks about a prepayment penalty, a lender will say it's a 5-3-1, which means that 5% the first year, 3% the second year, 1% third year, and then after that third year, nothing. It could be a 5-5-4-4-3-3-2-2-1-1 and go out the full term. Okay. It could be 5-4-3-2-1. It all depends. And the type of prepayment penalty will also be a factor of what the interest rate is. So if you have prepayment penalties that are longer, you may get a lower interest rate, because what you're doing is you're essentially telling the lender that you're going to guarantee that you're going to keep this loan for a certain amount of time. So they know that they're going to actually have a return on this loan for that time period. Now, there is, and insurance companies do this a lot, what they call yield maintenance. This is where, and a lot of buyers will come into it and say, I like this loan because it's such a low interest rate. Well, just like anything in life, risk versus reward, right? So the lender's looking at this as, I'm giving a very low interest rate. Interest rates are volatile. They may go up, they may go down. In this market right now, we're seeing them definitely going up. So what they do is they put on those prepayment penalties, but an insurance company that's giving a much lower or a lower interest rate, sometimes 50 basis points or 100 basis points lower than what you could get at a conventional bank, they're going to require what they call a yield maintenance. And what that means is, if you sell that property at any time prior to the end of the term, you actually owe that lender all of the interest they would have earned for the remaining. So that's your prepayment penalty. And in some cases, if you were to sell the property within a year of purchasing it, you could actually end up paying as much in a prepayment penalty as the payoff of the loan. Okay?
So it actually costs you money to sell.
It could cost money to sell. So this is really good. Those type of loans are good for people that have a lot of liquidity, that are don't have to worry about, you know what, I have to sell this property if something comes up. You know, they're not using this as kind of like a bank. It's more of an investment, and it's people that have a little bit more higher net worth, don't have to worry about having to sell the property or refinance the property, take cash out down the road. That being said, you know, everybody's situation changes, so you still see this come in. And the trade-off is that you are getting a lower interest rate. So in theory also, you can assume that loan, but the person that's assuming it will assume it based upon what they have. So if there's appreciation in the property, your down payment's going to be that much higher. So it can be very difficult. And, you know, when you're going in that route and you're speaking with your clients, you know, really that's something to really advise them and clarify that, you know, if yes, the interest rate is much lower on this loan, but if for whatever reason you need to sell this property or refinance this property after 10 years, it's going to really impact your returns. Okay. So bear that in mind with prepayment penalties. The other thing that's very different is the loan documents themselves. You know, residential loans, as I mentioned, are governed by RESPA, and all the loan docs are pretty much, you know, standard boilerplate for the most part. Commercial loans are not. So a lot of times you'll have your attorney review the loan documents and actually carve out and change things. You know, they can modify some of the language in the loan documents to protect the purchaser. And those are negotiable items. Some lenders, there are some lenders that refuse to negotiate, but most will. Okay. And then as we talk about guarantees, that's the other thing that's a little bit different as well. So the guarantees on a commercial loan vary, you know, and it really depends on the type of asset class and who the tenant is and what they're doing. For instance, if you're purchasing single tenant net lease with corporate guarantees as the tenants, and or a very strong franchise guarantee, they may not require any kind of personal guarantee from the borrower. Okay. Other types of loans, they may require personal guarantees, but your qualification is not tied toward your income. It could because they're also bringing in the income of the property itself. So this allows investors to purchase something that they, you know, if they try to buy a house for $4 or $5 million, they may not qualify for it based upon their income, but they could buy an apartment building for $4 or $5 million because the cash flow from the apartment is calculated into the qualification aspect. Okay, there still may be a guarantee. The other difference is that the guarantees may not be 100% of the loan. You know, you have partial guarantees in commercial loans. Okay, so the partial guarantee can be something as simple as, you know, it could be a 25% of the loan, it could be 50% of the loan, whatever percentage that you decide to negotiate. Now, why is this important? Anyone?
I mean, it'll widen your spectrum.
Why, when it comes to your guarantees in commercial loans, why is it important to try and either get as low of a guarantee or a partial guarantee on the loan? Okay. So the main difference when it comes to the residential and commercial, let's say if some of you remember during the last down crisis and the last few times, a lot of the residential properties were foreclosed upon. When a lender forecloses on property, you're typically upside down. They couldn't sell it and pay off the loan. That's the main reason why someone were to foreclose on a property. They stop paying on the loan, and they can't sell the property to pay off the loan, so it gets foreclosed upon. Now, in a residential single-family home, condo, multifamily up to 4 units, the lender can only take back the property. Meaning, let's say your home that you purchased has a $1 million loan on it, and at the time when you purchased the home, it was worth $1.5 million. The market crashed like crazy. It's $900,000. If the lender forecloses on you, they can't come after you for that extra $100,000 on a residential property. On a commercial property, however, they can.
Why lower guarantee? What is the?
Well, if you have a lower guarantee, it minimizes the risk of your personal assets on the commercial property if something were to happen. So if you have no guarantee, or your worst case scenario, you lose the property versus them coming after your personal assets as well.
But can you describe the concept of the guarantee in general?
Mhm.
Because I don't understand what's being guaranteed.
On a guarantee on a commercial loan, what the borrower is guaranteeing is, on a personal guarantee, is the loan amount or the remaining loan amount.
To pay back the loan amount.
Correct.
Okay.
Correct. The full loan amount itself, not the payments, but the full loan amount.
And that's
itself.
something that the buyer guarantees the lender?
Correct.
Okay.
Correct. Now, even on a loan that is with no personal guarantee, there is still technically a guarantee, and that's what they call a bad boy clause. Okay, and this is in every commercial loan. And a bad boy clause basically states that if the lender finds out that you lied about something, you did something bad, then all of a sudden it triggers a guarantee, and you're now guaranteeing that loan personally. Okay, so you can't just go in there, even though there's no personal guarantee, and just say, I make $10 million a year and this. It's not your personal assets. You still have to report them. They may not take that into consideration fully. Rather, they'll take it into consideration, but they're not going to necessarily take it into consideration on the guarantee of the loan, on the qualification process. But you still have to report your personal assets under a PFS or personal financial statement. Typically, every year you give that to them as well. Okay. Yes.
So when you typically think of loans, you think the word guarantee is something that the lender gives the borrower, but in this case, a guarantee can be seen, well, to someone who knows absolutely nothing about bank loans, the word guarantee and the concept of what guarantee is seen more as personal collateral that they're giving to the bank. So the more guarantee that I give the bank,
Mm-hmm.
the less risk the bank is taking.
Exactly.
Okay.
Yes. Yep. Absolutely. And then, in addition to that, that's also a factor. Again, risk versus reward. If you go for a loan that has no personal guarantee, you're going to pay a little bit more interest rate. If you give a personal guarantee, the interest rate may be a little bit less. Okay. So, and we're talking 25, 50 basis points. Basis points. I keep saying that, and I'm trying to be very good about trying to some of the terminology for some of the newer agents and newer people watching the video. But basis point is essentially, when we say 50 basis points, that's 0.5%. So, if you were to take a full 1% and break it up into 100, 1% is 100 basis points. So 25 basis points would be 0.25%. 50 basis points would be 0.5 point or 0.5%. 75 basis points, 0.75%. 100 basis points, 1%. So when you hear basis points, because that's what they typically talk about, they're going to say it's 50 basis points lower as opposed to 50, 0.5% lower. So just understand that as well. Fees. Here's something that's also very different when it comes to commercial financing. Most lenders will require you to lock in to them, commit to them. A commercial loan costs a lot more to underwrite than a residential loan. Okay, so with a residential lender, a lot of buyers may do multiple applications with the residential lenders. With the downside is that they're paying maybe for two different appraisers, right? $500-600 for the appraisal for a residential loan, depending on the asset and where it's located. And but a commercial loan, an appraisal is going to cost a couple $1,000s. Okay. In addition to that, there are other reports that they require and look at, and you are paying when you're getting a commercial loan. Part of what you're paying is you're also paying all the legal fees for the lender. Okay. So most lenders, what they'll do is they'll require a commitment from you, and you're also going to have to put in $10,000 typically up front. to that lender. Now that amount will be credited toward any expenses that they use, such as the appraisal, loan fees, and whatever else at the close of escrow. But it minimizes the downside for the lenders. The lender's always looking to minimize their downside on the commercial real estate loan. Okay? So overall, loans are loans, yes, but they are very different between commercial and residential loans. So, any questions, guys?
What are basis points?
Can you say that one again?
Yeah, absolutely. Yeah, just clarification on basis point. It's more of a terminology thing where, you know,
BPS, right?
Basis point, BPS, they can call it that as well, but, you know, very rarely do I hear it called that. Basis point is basically the interest rate that they're talking about. Okay. So when they say, you know, when you're getting a loan, they'll give you different options. Here's a loan that with a personal guarantee, it's at 4%. Okay. Here's a loan without a personal guarantee, it's 25 basis points higher, which is 4.25%. So essentially 1 basis point is
0.01.
is equivalent to 1/100th of 1%.
So 0.01.
Yes.
So 25 basis points would just be 25%.
A quarter percent.
Yeah, 1/4%.
Yep.
Okay. That's a
Easy way to remember it.
0.01.
Okay. Any other questions? All right. Well, I guess that concludes today's class. Thank you all for joining.